Hi, my name's Ben Shepard and I'm the editor of Global ETF Profits. A big challenge that's faced investors over the past 2 years is what exactly to do with their cash balances. Right now the prevailing average interest rates on money market accounts is right around 0.75%, and if you're going for high yield accounts, about the best you're going to do is 1.35%. So it really just hasn't paid to save. And that doesn't look like a situation that's going to change anytime soon. In the FOMC's most recent statement, the money phrase that they foresaw holding interest rates at the current levels of 0 to 0.25% for an extended period still appeared in the statement after the meeting. And most folks agree that that's an outlook for about 6 months. When they say an extended period, they mean at least 6 months. So right now, most analysts and economists are forecasting that rates will start rising probably in the fourth quarter, sometime between October and December. But still, what do you do in the meantime? For a lot of folks, it doesn't make sense to stay fully invested. Most people, want to have some cash on the sidelines to take advantage of opportunities as they may arise. And with money market yields so low, and your broker sweep account probably is maybe paying you 0.5% at most, what do you do? Well, there's been a trend in the exchange-traded fund universe for about 2 years now, where a lot of asset managers are starting to launch actively managed funds. These are ETFs that are even more akin to a traditional mutual fund, where you have a manager who's actively making buy and sell decisions for the fund's portfolio. And that's been a big break from the past, where typically ETFs have just been passive index trackers. So far, actively managed ETFs really haven't caught on, and I feel like that's for good reason. The big benefit for ETFs has always been the extremely low cost structure of these funds. And once you start throwing in that active management element where you're building up trading costs and all the other fees and expenses that kind of go along, you'll see expense ratios creep up. And I'm not necessarily sure that that's really a good thing. And because of that, actively managed ETFs really haven't caught on yet. Overall, their asset bases are still fairly low. Right now, there are about 28 actively managed ETFs on the market, and between them, they have less than, at last count, it was about $300 million in assets. Now, over the long term, that's probably going to change. The simple fact is, people like active investing, or else traditional mutual funds wouldn't still be, the huge draw that they are. But there is one active ETF in the space, one actively managed ETF in the space that kind of addresses these, the investor concern of what to do with cash. Pacific Investment Management Company, PIMCO, home of the legendary Bill Gross, recently launched an ETF they call the PIMCO Enhanced Short Maturity Strategy ETF. That's a long name, it's a mouthful, but the ticker is MINT. And basically what this is meant to be is an alternative to a money market fund. It's an investment grade bond fund. All of the securities in it are rated AAA or better. It's managed to keep the aggregate maturities at 1 year or less. The interesting thing about it is it doesn't use any swaps, it doesn't use any options, it doesn't use any futures, so things aren't too terribly complicated for investors at tax time. And the express goal of the fund is to generate higher income and total return than a money market fund. So far, that really hasn't proven to be the case. The yield on it is just 0.58%, which is basically middling as far as money market funds go. But right now, the ETF is only about 4 months old, so obviously, it takes some time to build up the portfolio and kind of get the ball rolling and to really maximize the effect of rolling maturities of the underlying bonds in the fund. And obviously investors are buying into the idea. So far it's accumulated about $178 million in assets in and of itself, and that's according to Morningstar. So, it's really catching on. That's not to say that it's for all investors, given that it is an exchange-traded instrument. You do have a greater element of market risk than you do with a traditional money market fund. But assuming PIMCO is successful in out-yielding money market funds using these very short-term high-grade instruments, there's really not a huge element of risk there. And another point there is that it's not all government securities. They are mixing in some short-term corporate issues as well. So over the long haul, I do think that they'll reach that vaunted goal of out-yielding money market funds, especially since they do have a low bar to beat right now. It is a great option for investors who need to sit on some cash but don't necessarily plan on having to tap into it for at least a few months. With that, my name is Ben Shepard. I'm the editor of Global ETF Profits.com.